our next presentation is here. It's an important part of everybody's life today. It's a countercyclical investment opportunity, and it's something that I've personally had a lot of experience and in investing in this particular space. It's something where I bought the world's first electronically traded receivable in the middle of a credit crisis in 2008, November of 2008. So this is working capital solutions are a very important part of every business. So today we have a very interesting panel on investment opportunities and working capital solutions to turn around the economy in time of COVID-19. With that, Shalako Wiener, Senior Vice President of Working Capital Solutions. Bank United is a member of FLIA. Shalako is going to be moderating this panel. So with that, I would like to welcome Shalako.
Yes, good morning, Mike, and good morning, everyone. Thank you for this opportunity. I think the key for recovery, as in any crisis, is how fast we can bring back into operation all these companies that have been affected by it. And as always, I like to say, if you cannot pay your suppliers or collect from your client, there is no purpose to exist as a business. So the big challenge that is going to be around is how we accelerate that cash that is trapped between the time of this company have to pay their supplier, their worker, all the costs, and the time they collect from their client. So the last 10 years, my panelists have been working on this issue, bringing the best technology platform and the most efficient structure based on different risk-return appetites for the investor. So this crisis is showing how critical it is to have in place good procurement and sales structure that help companies to act quick. So from an investor perspective, here you have an asset class that is diversified, short-term, with a spread that can be adequate to the risk profile that your firms are looking for, and in a non-speculative and a very safe structure. So I will let my panelists introduce themselves and then move on to the agenda. Then I will do a round of quick questions and then open to the public. So this idea is to keep it as interactive as possible. So welcome to welcome to Working Capital Solution panel. So I'm going to start with PJ.
Hi. Thank you, Shalako, and it's a pleasure to be with everyone today. Good day. Hope everyone is staying safe, healthy, and strong through this strange time that we're in. I'm PJ Bain. I'm the CEO of Prime Revenue. We are the leading independent multi-bank platform for supply chain finance and receivables finance marketplaces around the world. We are supporting today about 38,000 clients in 85 countries across 30 currencies, managing somewhere between $250 billion and $1 trillion of B2B payments, of which about $110 billion of invoices will be sold into our marketplace to help our clients accelerate payments, accelerate their receivables or delay payments, optimize their working capital, and make their cash flow more efficient. Looking forward to our discussion today.
Thank you, PJ. And we're going to continue with Hector de la Garza.
Hello, good morning all. Thank you for inviting us for this participation. My name is Hector de la Garza. I'm the CEO of eFactor Network. eFactor Network is trading and located in Mexico, particularly in Monterrey. We have been trading in our space in the marketplace for supply chain finance since 2009. We are partnered up with Prime Revenue in order to deploy and onboard companies in Mexico and banks in order to make supply chain finance. We traded $4 billion last year. Cumulative, we have been trading for more than $16, $17 billion since we started off. with over 50,000 suppliers and 35 funders. And we are beginning to deploy programs that are global in order to make supply chain finance a part that is important for working capital solutions for big corporations and their suppliers. So thank you very much.
Thank you, Hector. And we're going to continue with Deepak Oja, which is part of Highmore Capital.
Thanks, Shalako. So I'm Deepak Jogia, managing partner and co-founder of Highmore. We're an alternative asset management firm that advises on $2 billion of assets. I oversee and manage the trade finance business at Highmore. We work with companies across both the low middle market, and even the investment grade space, working with them to release working capital through typically three forms of financing. Their accounts payable, and that's supply chain financing, vendor procurement, through the receivables, through accounts receivable discounting, as well as purchase order financing. You know, we work with companies across a range of industries, predominantly in North America, but just given the nature of definition of trade finance, it's very much a global business. So, you know, for us, you know, what really differentiates us is the speed and efficiency with which we can evaluate and execute financing opportunities. We really partner with management teams. So while we're looking to provide a financial return to our investors, we really look to build strong relationships with management teams and really support them, which includes providing strategic advice and then really understanding their industry and their business model to really find a tailored solution.
Thank you so much, Deepak. And we're going to finish with Hernan Mayol from AR Global. Hernan.
Thank you, Shalako. Thank you, everybody. Hernan Mayol. I work for EIA Global, one of the largest independent trade credit insurance brokers in the United States that has been in existence for 40 years, helping mitigate global portfolios. I've been a banker for 25 years and an advisor. I work with Wells Fargo and Bank of America. Wells Fargo, obviously, that's where I had my first experience with EIA. I've been in the global trade and supply chain working capital space ever since in business development and product management. I am currently the chairman of the Trade and Lending Committee for FIBA, the Florida International Bankers Association. I'm in the ITFA Board of the Americas and also the country manager for Planet of Finance. And to me, it's a pleasure to share with you my perspectives on the market. Thank you.
Thank you so much, Hernan. So now the idea is to get all the audience in a process that we're going to go through a micro view of what is supply chain and what we see in it, and working capital solution. And then we're going to go more to a micro view and implementation and what we see from that perspective. Then the investor perspective that Deepak's going to help us to understand how as an investor in supply chain and working capital solution opportunity see. And then finally, from an insurance, one of the largest brokers insurance, what all the alternative for risk management depending on the risk appetite. So I'm going to pass to PJ from Prime Revenue for the micro view.
Yeah, so thank you, Shalako. I think when we start talking about supply chain finance and trade finance, one of the big questions that I get is how does it benefit corporate clients? And I think at the moment, every one of us is acutely aware of the value of cash. The statement that cash is king always holds up. But in times like this, you see corporate leaders really forget about the P&L and balance sheet for the most part. And they become myopically focused on the cash flow statement. Why? It's because cash is what makes the world go around, and cash is the shock absorber that allows us to survive volatility like we're seeing right now, especially in times like now. And the most efficient source of getting access to that cash for every company is working capital efficiency, accelerating your accounts receivable, delaying your accounts payable, and then minimizing your inventory to the greatest extent that's possible. So trade finance can have a massive impact on all three of these: days sales outstanding, days inventory outstanding, and days payable outstanding. In March alone, Prime Revenue accelerated $10 billion in early payments to thousands of companies around the world. And when you think about it, that's $10 billion that wasn't necessary in stimulus funding. It was $10 billion that those companies were able to very quickly access by selling their receivables into a marketplace to turn their receivables into cash that give them that shock absorber to be able to deal with the timing of the volatility.
That's excellent. Thank you, PJ. We're gonna, Hector, can you give us like more the micro view and the implementation that you've seen through the different program that you did in Mexico?
Yeah, of course, thank you very much. So basically, in Mexico right now, the big corporations are supporting liquidity problems through two big channels by renegotiating the contracts that they have with the banks in order to extend the terms that they have today. I'm talking about short-term loans, but also they have been supporting a lot on supply chain finance programs. In Mexico, the supply chain finance trading started in 2001. So a lot of corporations has today a program with a bank or with a multi-bank platform in order to support their payments to suppliers. And the banking system, they have an understanding of the situation today. So they are trying to support this term extension that they need. But in order to keep the credit lines available and the capacity, they have to negotiate step by step and depending on the industry where they are trading. So negotiations through manufacturing versus commercial companies on the big corporation side are of course different. And the impact on the rates together with the risk aversion of the banks in order to continue with some credit lines have a complex situation for these negotiations. So basically what we are doing today is to support these negotiations through supply chain finance and attend also with alternative funders that are not part of the banking system as a private commercial bank, such as multilaterals like IFC or the Inter-American Development Bank or Bancomex here in Mexico. So they are countercyclical funders that can help to support SMEs and suppliers of these big corporations accordingly. So basically, this is the situation right now, and the requirement of this product has grown a lot. So we have other companies that are truly interested to deploy this as fast as they can. So basically that's what's going on here in our region, to pay to Mexican suppliers, but also to foreign suppliers that are located in the US, Canada, and other countries.
Thank you so much, Hector. Deepak, what is your perspective and opportunities that you see in supply chain finance as an alternative investor? If you can tell us a little bit. Thank you.
You know, it's really been interesting to see what's been happening over the last couple of weeks with the bifurcation between the real economy, Main Street in North America and frankly globally, and the marketable securities market. I think we've seen, firstly, if I were to segment this, a lot more acceleration in deal flow and frankly quality deal flow. We've certainly seen, traditional lenders and even traditional the natural purchasers of receivables step away. Give you an example, In our investment grade bucket, we purchase receivables on an investment grade company in the healthcare space selling to an investment grade buyer. That market, typically, very well funded. The banks are the go-to buyers there. Paper that used to price at LIBOR plus 60, we were able to obtain LIBOR plus 350 in terms of the pricing out there. So clearly, we've seen and we expect the margin to also increase. But if you really step down to the higher yielding space, which is the middle and lower middle market, we're also seeing the ability to be a price maker increase significantly. And beyond just price, the ability to drive terms from a structural perspective has also increased. And I'll get granular with the group here. We recently entered into a receivables purchase program with a company that is in the business of designing and manufacturing smart meters, and their end clients are large publicly traded utilities. So clearly a mission critical product. They've had really no disruption, and a company of that size, we're able to earn a gross rate close to about 15% in a more liquidity friendly environment. Your security agreement for a company of that size would typically just be the accounts receivable. We were able to ensure collection of all of their cash flow on a daily basis. We have a blanket lien on the company, not just the AR, and we have a personal guarantee from the ultimate owner of the business, which has some real teeth. So it's not just the pricing, it's also the structuring considerations where we're really able to set terms.
Thank you, Deepak. And yes, I think definitely right now there is a good opportunity for investors to get higher yields in this type of product that were more traditional for the institutional organization. So now I would like to switch to Hernan to give you a quick view of insurance, how we can mitigate the risk, what are the products that the insurance can have it, and then I will jump to my question to the panel. Hernan?
Excellent. Yeah, if you can share my slide so we can explain to people a little bit about the benefits of what we do. All right, here we go.
Hernan?
Yes, perfect. So one of the things that I wanted to share is trade and political risk insurance is something that's been used for many, many, many years. And people are familiar with government programs, but not so much on private trade credit and non-payment insurance, particularly in the alternative financing space. And why do lenders, particularly the specialty lenders, need credit insurance to mitigate the portfolio? Why they use it, no? The most important thing is to have risk protection on counterparties, of course. The other one is to have a cost-effective portfolio management tool, increase lending capacity to those assets that are good assets. You can hold attractive learning, and it helps you in the risk return considerations, and also you expand the client's borrowing base. So it allows you to do a little bit more, particularly when some things are ineligible. It makes this eligible for the asset and portfolio mix. The next slide. This slide explains a little bit about the types of coverage that we have that are available. And if you look at purely political risk insurance, you can look at investment insurance on the equity and lender form, or you can look at property-based insurance. So let's say a company like Walmart has offices around the world. and they have locations that if there's something happens in Mexico or in a country where there's a crisis, there's protection against that. And then the most used is really non-payment risk insurance, and there's several types. So there's whole turnover, ad hoc sometimes insurance, long and short term, and there's also non-trade insurance for working capital, real estate financing, and of course supply chain. And people that use it are the gamma of primarily lenders, and I'll explain a little bit why on the bank side. But there's all types that you'll see in a little bit. So next slide. So this is the traditional and the largest market for trade credit insurance at this time. And I want to share some statistics. So the World Trade Organization reports that 80 to 90% of the world's trade is in some way reliant on trade finance. So imagine that. And out of that business, so the Secretary General of the Berne Union said that trade goods and services need bank financing. Credit insurance enables banks to provide this trade finance. In a current very challenging environment, we welcome joint efforts by the public for the use of credit insurance in their portfolio. So this is the head of the Berne Union, that is the organization that basically creates the parameters for all export credit agencies, government agencies, but also the private insurance market. They look at the Berne Union for a lot of statistics and to cover the gap that the governments cannot do. So again, back in this space, supply chain financing. So the next slide just shows, some of the segments that credit insurance cover: commercial loans, syndicated loans, securitizations, real estate financing, acquisition financing. The key here is to look at the overall portfolio. So the credit insurance market, yes, they look at individual lending activity, but really what they want is a relationship and a partnership with the people that are getting coverage, so that they manage the business together and look at the portfolio as a possibility for growth. So that's where we use credit insurance. The last is a slide that will share. Obviously, there's 40 plus investment grade credit insurance companies that we deal with on a day-to-day basis to manage our billions in portfolios. During this COVID-19 period, we have been working very actively with our bank lenders and our exporters to make sure that they have their policies in place, that they are, that if there's any collection that needs to be made, that they have all the proper documentation. So we work with these lenders and exporters to make sure that they are covered, right? So this is the important part.
Yeah, thank you, Hernan. Now we'd like to jump to a few questions. PJ, how can supply chain and trade finance benefit corporate clients, and why alternative funding is not more mature in supply chain and trade finance? What is your vision on that?
Yeah, so first of all, I think, as I mentioned a minute ago, cash is king and cash is going to be a shock absorber. I think I would reiterate what Deepak said just a moment ago. We're seeing very rapid growth in a lot of forms of trade finance, which is creating opportunities for alternative funders to step in and bridge a gap that traditionally maybe the more typical trade finance banks would have provided the liquidity for. But I think, especially given the speed with which slowdowns have occurred, economies have sort of ground to a halt, and supply chain has halted, it just really emphasizes the need to be able to access liquidity very, very quickly. And what supply chain finance does and trade finance in general does is it allows companies very quickly to have access to money that they've already earned. So by creating a marketplace where companies can go and sell their receivables, they're accelerating that payment on that receivable that they would earn anyway, but they can accelerate it usually fairly quickly. For instance, across most of the investment grade programs that we manage, the large enterprise programs that we manage, the average tenor is about 62 days. So their supply chains can accelerate 2 full months of what would normally be sitting on the balance sheet as accounts receivable. And likewise, these large buyers can extend payment terms and gather a couple of additional financial periods of holding on to their cash. And so that gives the corporate clients much needed cash to be able to really better manage their business, better manage their volatility, and better be prepared to deal with the uncertainty of the times that we're in. And I think that that's creating some opportunities around alternative funding, to your second question about why it's not more mature in supply chain finance or trade finance. And I think that answer is a relatively complicated answer. It's the process of the evolution of a number of concepts and the collision of something that has traditionally been a tool that's provided by banks, i.e. trade finance, and the investors of managing the alternative funds management and deploying of that capital. So we are seeing those markets converge and those opportunities converge. I see it accelerating at the moment. So it's a very complicated response, but I'll really respond to 3 items. First of all, yield. Supply chain finance and trade finance is a well-known tool to large global investment grade enterprises. But the yields on those are typically very low. Those assets are typically very low. I think Deepak mentioned a minute ago, 100 basis points. Our typical investment grade program is originating hundreds of millions or billions of dollars in invoice assets that look just like commercial paper on an annual basis, but the returns are very, very small. The returns are typically less than 100 basis points over LIBOR. But as Deepak mentioned, that's changing dramatically right now in the investment grade space. The price is changing and the availability of liquidity is also changing very rapidly. And that's in the investment grade enterprise space. We also, a few years ago, Prime Revenue and a number of other players in the market started moving into the middle market. So companies between 100 million in revenue and say $1 billion in revenue is what we would consider middle market. Those are sub-investment grade. They don't have access to the same high efficiency sources of cash and capital that an investment grade company would be. And that market is a little bit different. That's really been an alternative funders market since day one. And that leads to my second point, which is the second thing I think that's holding alternative funding growth in supply chain finance and trade finance back is availability of the assets to match the liquidity. It's traditionally been a bank's market where the bank provided the assets, and there's a number of independent players like Prime Revenue, but most of our liquidity is provided by banks. And that's changing. It's changing dramatically, and it's changing very rapidly right now during this period of COVID-19. And then the third thing I think is that is holding alternative funders back a little bit, but educational processes like this are really helping us. It's understanding how the supply chain works. So if you've been paying attention to the news or you've been paying attention to the comments of what's happening in the world right now with all of our global supply chains, that's the physical movements of goods and services around the world. And what trade finance does is it helps to make the movement of the money that follows that physical movement of goods and services more efficient. But it is a very volatile and it's subject to volatility. And so sometimes the volatility is unknown. It's typically not a bond type structure at the source of origination. So it requires strong cash flow management capabilities. It requires strong treasury management capabilities. And often it takes time to bridge that gap between the understanding of the fund managers that are trying to deploy capital and the originators that are trying to manage the flow of the assets into the marketplace. So to wrap up those 3 things, the yield, the availability of the assets, and understanding how the supply chain works, we are seeing an acceleration of alternative funders joining trade finance programs when compared with traditional trade banks. I would say it hasn't quite reached a tipping point yet where it is a substantial and major portion, but we do know that in the current economic condition, we are really seeing a huge, huge need for corporate clients to access supply chain finance and trade finance tools. And that is a great opportunity because a lot of the banks are pulling back and raising the price. So it's fixing the yield and it's fixing the availability of the assets. So the remaining point is to do exercises like we're doing right now and to help bridge that gap so that there is an understanding of how the supply chain works from a financial perspective.
Okay, thank you, PJ. Before we love the view of Deepak on what you comment, but before I would like to, Hector, can you give us an idea, like you two platform have been working together, so how platform mitigate fraud, operational and credit risk, what are the key considerations about that, and what is kind of your current makeup of funders across the different spread that you have today in the platforms?
Thank you, Chalaco. Yes, the first thing is that technology brings us the possibility to facilitate a lot the access for all the users among the community of this marketplace. And it is incredible how through a program, a financial program, we can bring the possibility to fund a supplier that is located in Italy, but with a risk in Mexico and a funder in the US into one supply chain finance program. This means that the technology can enable through the legal frame that kind of possibility. So this brings us the possibility to make efficient markets, a very efficient market. Because in Mexico, for example, we don't have a natural source of funding for USD, for dollars, right? So if we bring a foreign funder, like a bank or an alternative funder, a private equity fund, etc., it will bring us the possibility to have a better rate than if we issue that type of facility in Mexico. So if we have a model where we can bring all together with the proper risk, it will provide these types of efficiencies. But not only that, the market gap for the margin for the funders is very interesting for this product. Probably you can fund Whirlpool through a working capital credit because of the good risk that Whirlpool has in the US, probably, I don't know, LIBOR plus 50 basis points in a direct lending, or LIBOR plus 25 basis points. But the interesting thing of this product is that you can raise the margin because the payment of the interest rate of the discount is going to be made by the supplier. So the funder can bring a LIBOR plus 125 into the supply chain finance market. The supplier is going to pay that because the risk of the invoice is low because the debtor is Whirlpool, but it provides an extra margin because of the facility. The debtor is Whirlpool, and the one who is paying the invoice discount is the supplier. So that combination is difficult to find in other financial products. So then if you move to Whirlpool Corporation that has a company subsidiary in Mexico and other countries, then the risk changes in order of the funding capabilities, so the rates move forward to have different margins according to the state. So in that sense, technology and the financial structure that we can provide for this model, it brings more than technology in the sense of TI or IT, but also the technology applied on the legal frame, the technology on the operations, and in the funding model. So this brings together a big capacity to fund and make this product grow rapidly because it's a very low risk debtor product, and it can provide some margins. despite that the margin is low, is better than the one that a big corporation can approve or accept to a big funder. So this brings the possibility to have a marketplace with a very small rate of due payments at maturity, and brings a space to grow.
Yeah, thank you, Hector. And definitely, we always have that debate about margin. And through all my banking expertise, being a corporate banker, there is always like, oh, maybe we can make more spread with real estate, all that. But what people don't realize is this spread, even though they're lower than other products, and I agree with Deepak, this is increasing tremendously just because institutions in time of crisis tend to froze and wait as being highly regulated. So they have to take extra step every time there is a crisis, and until the investor can be faster and take over all these opportunities, and that's where the margin is. The other interesting part is the margin is embedded on the transaction, on the sales transaction. So a good supplier can always embed in their invoices some financial costs that then can be discounted and have this investor taking advantage of it. So I think right now the market and in crisis is always a good opportunity because, as I say, you have to pay your supplier, collect your client, of then your business doesn't make any sense. So I don't know, Deepak, if you want to jump in a little bit, or what is your feeling of traditional funders stepping away and open this door to alternative investment, and why your fund is eager to enter on this business, and how you see that your risk is diversified and mitigate compared to other type of investment that funds do?
I think there's a lot of good salient points being made, but kind of starting with what following on from what PJ was saying, that, and we've always been the advocate or cheerleader that trade finance, whether it's supply chain or receivables financing, is a legitimate sector in its own right within fixed income investing, and people should view it as a complement to either their traditional fixed income portfolios as well as their more what I call true direct lending strategies. I think to your point, Shalako, investors ask us, what happens with these businesses? Well, if you're investing in, with Main Street businesses, whether investment grade, obligors, or middle market or low middle market, they have a viable business and they're nimble. We're certainly seeing businesses still operate, and we see collections. I think the other aspect is that technically what we're all involved in this business is characterized as asset purchases, whether it's on the payable side or the receivable side. So you get a different treatment from an audited financial statement perspective. But I think ultimately that the short tenor of these transactions, so we engage in transactions that revolve anywhere as short as 30 days to as long out as 130 days, and then you are revolving the dollars on that cycle. And ultimately, it is an operationally intensive strategy. You've got to manage the transactions and verify that you have a legitimate transaction. You're mitigating fraud risk, and then ensuring that you're protecting yourself from a credit perspective, and in terms of using amongst other things like credit insurance.
Excellent, thank you, Deepak. I'm going to jump to some questions that we haven't. So the first one, they're asking Rod Amos about if we are aware anyone providing working capital debt or equity to the cruise ship industry operator, and they can also public market. I'm going to say that what is important in working capital solution, and again, I go back to always the suppliers and clients. So we are entering in that covering that gap. So any investment and the use of platform, and we're going to see with the next question on how to avoid fraud, we need to have this flow of receivables in general. So we pay the supplier, we collect from the client, and we cover those 60, 90, 180 days, depending on the I would say, unfortunately, right now, the cruise ship industry is totally unstopped. So I don't see anyone be able to jump in a working capital solution the way that we see on the supply chain on an industry that is stopped. That's why it's very important to understand that these products are for companies that turning around, and that's why it's so critical, supply chain financing, when the markets reopen and when the economy grows, because this is how fast we're going to accelerate the cash conversion cycle of the company to be back to full operation and start hiring again and start growing and get their margin as quick as possible in order to reinvest. So I would jump in the second question about fraud. So I would like the feedback from Hector from eFactor and some from PJ, and maybe we can have some historical from the insurance perspective on fraud on supply chain. So I'm going to start with Hector.
Thank you, Jaco. Fraud is an important issue here in this product, and it's very interesting how technology and the legal frame solves this situation. For this model, and because the debtor is confirming the invoices into the platform, it provides a lot of security into the transaction itself. So, for example, in our case, we decided since we started up to trade up only with private sector, because we are in Mexico, right? And we decided to go on that sense and confirm every transaction with the proper party. If you rely on the technology and the legal frame and you integrate the funders that are reliable, then you can provide a secure marketplace. I think in that sense, and because of the history of the product that we have seen since 2001, when we started to trade supply chains finance here in Mexico, I started first in a development bank called NAFIN. The first 8 years, we only saw one case of possible fraud of a supplier that wanted to complicate the transaction by lying and saying that he didn't trade. But when you have all the technology and you have all the invoices secure and deposited into the platform, and the law allows you to prove that that transaction existed, is enough in order for a judge to fulfill the compliance that he wants to do. So after that era at eFactor Network and with the partnership with Prime Revenue, we continue that type of model, and we fortify it through this commercial and technology alliance that we have with Prime. So our contracts makes, along with the technology, a transaction that is secure, because we rely on the confirmation of the big corporation. Now, on the corporate sector is pretty secure, and in that segment, just some of corporations are going to be fortified with insurance, for example, in order to reduce the credit default possibility. But in the middle market segment, it is important to go and fortify with insurance in order to rely and support the solvency and the possible lack of moral hazard of middle market companies. So in that sense, there's a big opportunity on the middle market, but with the tools that we have today in order to reduce the fraud, it's a very good market in order to grow. But I can tell you today, after 19 years, just one case, and it was solved, even though in Mexico, where maybe the perception is that there's a lot of possibilities for fraud. So if you do the scheme using the basis that you need to deploy, and you will reduce at the maximum the fraud, and also the credit, the due payments. We have zero today. Despite this COVID situation, we have not been seeing any default in our customers, 5 years in a constant manner. So of course, today is going to change a little bit because this external factor, but our situation, but not along with the fraud, but with the possibility of solvency of some sectors in this market.
Excellent. Thank you, Hector. PJ, you want to do some remarks about fraud and maybe default rate that you'll be seeing through the different programs that you have on your platform? A little feedback on that, and then probably Hernan can talk from an insurance perspective after.
Yeah. So thanks, Shalako. Yeah, just following up on what Hector said, it may be helpful for me to provide a little bit of a description of the technology that we provide. There's a number of components to the technology aspect of running a supply chain finance program or a supplier finance or vendor financing type of program. And what we have tried to do with the legal structure as well as the technology is to isolate the risk to buyer default risk. I'm sure everyone is familiar with factoring and how factoring works. And the largest risk within factoring is fraud, a fraudulent invoice. The way that supply chain finance works is when we sell our solutions, our technology solutions to a large buyer client, the top of the supply chain, one of the first things that we do is we integrate into their accounting system, into their ERP systems globally. And so when the goods and services are delivered and an invoice is sent, that invoice is entered into the accounting system. As soon as that invoice is approved in their accounting system, we integrate with that accounting system and pull that approved, confirmed invoice onto our marketplace. So we're actually, what the investors or the banks or the alternative funders that are purchasing the receivable are actually purchasing from a legal perspective is an irrevocable obligation to pay that is date certain and sum certain. And the technology vendor, Prime Revenue, in our case, it has power of attorney to move the money on that date certain maturation date of the invoice. So it is possible, I would never say it's impossible, it is possible for fraud to occur, but for fraud to occur, it typically has to be multi-party collusion. There has to be collusion between the supplier to create a fraudulent invoice, the parties at the buyer that actually approve the invoice, because those are most often done in some sort of technology system that would be a supply chain management system or a warehouse management system to receive the goods before the invoice is then approved by someone in the accounts payable department of the buyer. And so you have to have multi-party collusion. There have been instances over the last several years. Fortunately, Prime Revenue has not been a party to that, but there have been instances, and it's the cases that have been caught have always been multi-party collusion. So the fraud, there's obviously going to be lots of fraud risk in factoring and unconfirmed receivables programs. Supply chain finance and vendor-led financing programs, it's very difficult, and a lot of that fraud risk is mitigated. In terms of default rates, I would say, like Hector, I can think of a couple of instances where we have had defaults, but it is almost always a dilution type of risk where if the buyer does not have the capability to be able to pay their suppliers, Shalako has said it many times, you have to pay your suppliers or you're out of business. If you're not keeping your supply chain running, you're not going to generate the revenue that you need to stay in business. So AP trade gets paid, and it is our default risks historically across Prime Revenue's platform and across the industry. We've participated in a number of sort of anonymous studies where we provided history. Some of the large banks have provided their history. The default rates for supply chain finance are significantly lower than any other default rates, including similarly credit rated commercial paper and corporate bonds. So very, very low default rates and vendor-led. And it's not that different as you go down the credit spectrum, because even the mid-market companies that may be, say, a double B, they're not going to be a single A rated company. The same rules apply. Trade gets paid. They have to pay their suppliers or they're out of business.
Thank you, PJ. And I totally agree. Through my 20 years doing trade finance and working capital solution, I would say the major risk is always fraud. And then the key to fraud is, and I think technology platforms have been enhancing tremendously this kind of product or challenges that in the past factoring had a bad reputation for that, in order that bring in the blockchain connectivity, and it's an extra leg of knowing your customer, which at the end is part of the 5 C's of credit, that the character is the most important, and the only way to validate character is to do a proper due diligence. And so I know that through platform, we do KYC from the supplier to the client, so everyone is connected and everyone knows to each other, and that's key to avoid fraud. And also then the capacity of anyone to repay their supplier or collect from the client is something that from an institutional perspective, we always validated as the skin of the game, that for this company to have the right capital. Your collateral, you have a receivable, which in most of the world today is a negotiable instrument, as valid as a promissory note or a draft. And then to understand what is the purpose of this, covering this gap. You see in the industry, some of the industry going over the cash conversion cycle, which could be a mistake, or using the wrong product for the wrong purpose. So we need always to understand what are the conditions, who are the key suppliers, who are the key clients, and what are the conditions, because that's what makes the wheels to run. And Hernan, I know that insurance never covers fraud, so that's why it's so important that all the participants in this program, we know who we're dealing and who we're investing, and we work all together as this panel. A lot of us were working for many years. So, and what is your perspective? I would say more in default rate than fraud, as we know insurance don't cover fraud, but on trade finance. Well, how do you see it?
Well, let me give you a thought on fraud first. And fraud is important to understand that, first of all, fraud is going to happen most likely if you mismanage the activity. That's why you have expertise in the market, banks like your bank. So I ran that business for 7 years for supply chain for Bank of America. We have experts in staff that all they did was look at documentation, look at the sources, make sure that the purchase orders are correct, all even electronic, and also in our operations team. Second, and most importantly, with the innovation on blockchain, you're gonna solve a lot of these issues, because you're gonna know where the source comes from, and you're gonna have digital signatures and ways to mitigate that fraud. But still, you need experts in the market, trade finance bankers, and supply chain platforms, right? Like Prime Revenue, that are people that this is what they do day in and day out, right? The insurance markets love that. The insurance market loves that you're managing this correctly, because they can make sure when they partner with you in these risks, that these things are going to be well managed, and they don't have to worry. Nobody has to worry about whether fraud is going to happen or not. Yes, there have become issues, but in my experience and the 25 years that I've done this, Oceanografía in Mexico, right? It's a big case that happened, and there was fraud involved for mismanagement. It was overlooked by certain people. That's why you have to have and deal with experts. So the alternative investment space needs to work with trade finance and supply chain experts. Now, on the default rate, this is important. So we, on a day-to-day basis, and the broker, what we do is to find the best coverage possible, to make sure that you're covered from all these insurance companies that are supposed to pay you at the end, right? And make sure that you have the proper documentation done in a timely fashion, and that you pay your insurance premium. Sometimes that's what happens. People don't want to pay insurance because they think, oh, no, I don't need insurance, right? Now when you're in crisis management mode, right? Everybody's running for the hills, and nobody can invest. For example, you mentioned it on cruise lines. So people, of course, if you had coverage on cruise lines and non-payment coverage on cruise lines, this is the time when they are valuable, right? So do you want to be in the next crisis? This is why you partner with an insurance company, make sure that you're covered at least a percentage. And when you see that things are getting worse, that you work with the insurance partners to make sure that you have the higher coverage if possible, right? And make sure that you get paid. So we work with the underwriters to make sure they pay our clients, right? And we've had very few, less than 1% non-payment on these covered portfolios. And it's, you know, a rarity, but it happens.
Thank you, Hernan. Sorry to cut, but I think we're running out of time. So I want to thank all the panelists. If you have any questions, please, you can submit it through Flya, or you can find us, a lot of us on LinkedIn. And Mike, I return the mic to you, and have a good afternoon, everyone.
Shalako, thank you. Thank you to all the panelists, Working Capital Solutions, Investment Opportunities. Very interesting segment of the current environment and what we need to really jumpstart the economy. And for people looking for investment opportunities, I encourage you to reach out to me. I can put you in touch with the gentlemen that are on this panel, or you can go to our marketplace and register on our marketplace to view some of the opportunities in this particular space. Again, I want to thank our sponsors, Preqin, Millennium Trust, Apex One Investment Partners, Entrust Global, eFactor Networks. Thank you all for helping make this event possible. Without your support and guidance, we would not have been able to produce such a high quality and great event again. Thank you to all of the Flya members and the Flya board for your support during this challenging time. It's amazing how our community has come together to provide leadership during great uncertainty. I'm proud to be a part of this group, and I wanted to, welcome the newcomers to the webcast today, and for the people coming back. Thank you again for your attendance and your support. We've had a lot of people online today. We had a great registration numbers for this event. The numbers are fantastic. So coming up in a few minutes is Mike Mullaney. For those of you that don't know him, he's with Boston Partners. Boston Partners has, roughly $90 billion in assets under management. He's the director of global market research there. They're located in Boston. They have a hedge fund. They have separately managed accounts. They have mutual funds. It's a great organization formed in the 1990s. The team's been working together for over 25 years. Mike's got fantastic insight, and he provides that on a regular basis to our members of our organization. We're proud to have Boston Partners as part of our group. And even though today is talking about real estate, direct lending, private debt, one of the things that Mike brings to this conversation is a finger on the pulse for macroeconomics. And I hope that you all find his presentation today, which will start in 2 minutes, as interesting as I have and as helpful as I have over time. It's been great getting to know Mike. Couple of housekeeping items. We have 3 upcoming webcasts for 3 of our members. Off the Chain Capital, they're a digital currency and blockchain asset investment manager. They're going to be hosting their event on May 7th. If you do not know Brian Estes, the chief investment officer at the firm, you should. The guy's great. His presentation is extremely insightful. It'll be hosted on May 7th at 1 p.m. Eastern Standard Time. I encourage you to join. On May 14th, Mike Griffin from Hedge Act, he will be doing a presentation on generating a steady yield from America's retirement surge. It's a litigation finance strategy, excellent returns. I've known Mike for 10 years. He's a great guy, very smart guy. They have an exceptional firm. I encourage you to join that on the 14th at 1 p.m. And then on the 18th, we have Safe Harbor Equities. Rafael Serrano, he's going to be doing a deep dive into distressed, and the title of his presentation is Evaluating Distressed Debt in the commercial real estate arena. Rafael's been around the block for a long time. He knows how to manage money in this space. I highly encourage you to attend his webcast.